When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what the investment opportunities are and threats in 2025, what the retirees need to know about income in retirement. We'll also answer some listener questions, and finally, how to plan for retirement for an unknown future. My name's Jeff Shea, and as always, I'm just here to ask the questions, but you know the answers, and the words of wisdom, they come from the other Jeff. It's Jeff Fogan, founder and president of Premier Retirement Planning Wealth Management. Hey, Jeff, how you doing today?
I'm doing great. How are you doing?
Oh, I'm doing well. Getting ready for the Super Bowl tomorrow. Chiefs and the Philadelphia Eagles. I don't know if the Eagles can be stopped, but we'll wait and see.
They got the referees on their side over at Kansas City, so they got 16 men on the field or however many.
I don't know, but they also have the viewing public there. A lot of casual football fans are tuned in. It may be the only football game that they watch all year, but they'll be watching for those cutaways to Taylor Swift. So
of course, the Swifties.
It's just more of the same. Anyway, it starts in the evening, Eastern time, late afternoon here in our time. Okay, Jeff, let's talk about our first topic here, and that is planning for the known and the unknown here in 2025 and what the threats are. So should we anticipate growth, but much like the wood snake, that is the Chinese animal of this year, should we proceed at a moderate pace and with caution, do you think?
Well, it depends on what stage you are in life. I think there's times when you don't have to be cautious and times when you do. I think if you're getting close to, retirement and you want to preserve your assets, it depends. If you've got $20 million in the bank and, you're living on $300,000 a year, I don't think you're going to run out of money no matter how stupid you are with your investments unless you just really throw them away. As far as being in the market, not being in the market, you can make some bad loans to family, I guess, and never get that money back. But I don't know how bad you could burn through that much money. But, not everybody has tens of millions of dollars to retire on. Most people are lucky to get to $1 million or $2 million or maybe a little bit more than that. And if they get there, they've been living on six figures or better. And if they want to continue to do that, they're, not probably in a position to lose half their money in the next market crash if they're ready to retire this year or next, or they just retired a year or two ago. I've said so many times that story about Norm back in the day when $1 million was a lot more than it is today. And that was back in the 2000 crash. He had retired from a chip company up at, actually, I'll tell you, it was Intel. And he's an engineer up there, made the Pentium chip and, got that product going and had $1 million in his 401k and, thought because the market was going to the moon and they said it would never come down and it was different this time and all the things that we hear that turn out not to be so true. He invested, he kept his money invested. Of course, most of his stuff within tech stocks, they lost 76%. I think that first year, over time, the bottom was top to bottom was about 80+%, 81 or 83, something like that. If you got tech stocks going down 80% and you're spending money, that $1 million that you had isn't coming back because you spent a bunch of it on the way down. So, he came to me about 10 years later and explained that, I don't know what to do. You seem like a smart guy, Jeff. Can you help me? And, at that point, his investments had got back to about half what they were just right before the '08 crash. He came to see me in '09. So it'd been almost 10 years since he retired. And he's like, now I'm back to 250. And he says, I'm barely in my 70s and, what I'm going to do here. And I said, I don't know either. And we parted friends. I asked him if I could share the story. And it's made a lot of difference to people just to kind of rethink, where we are in the market cycle. And, he retired when the market cycle was really high. Everybody was in this euphoric, complacent stage that kind of like what we're in right now, where, it's just going to go up. It's just going to go up. It can't go down because, look, we got AI, we got energy, we're drill, baby, drill. We got Trump back in office. Everything's going to be hunky dory. Well, maybe not. You have to realize, what your money's for. If you have just enough that if you've saved a lot and been responsible and you have $1 million or $2 million, or maybe even a few $100,000, but it's just enough to get you over the hump from what Social Security or your pensions cover, you probably can't afford to lose half of it. So I think you need to be cautious going into the market as good as it looks, especially when historically it's overvalued. I just looked at the Shiller price earnings ratio, which I don't think it's even, it's only been higher than this once, and that was in .coms. It's 38. $38 is what we're willing to pay for a typical stock based on the trailing prior 12 months earnings. Now, everybody's saying, yeah, but the future earnings are going to be X. Okay, well, great. Well, I'll just tell you about one stock, and I'm not going to name the name of the stock because if you own it, you already know it. And I don't want this to be construed as a recommendation because the stock is so overvalued right now, in my opinion. But this stock has gone up about 400% in the last year or two. The company is trading over $100. It just declared earnings of like 14 cents a share. I mean, just something stupid. But the earnings grew at 29% from year-over-year earnings. The revenues are pathetic. This is a multi-billion-dollar market capitalization. So we're paying, the price earnings ratio is like 400. So if you just took the earnings at current levels off of that company, it would take you 400 years to get your money back on an investment for a share of stock. Now, obviously, we hope that the future grows, but guess what? They're expecting growth to go at about 20 to 25%. So why in the world are we paying, when we have price earnings ratios on average of 38, we have some companies at 300 and 400, and their earnings currently are only growing at 20 or 30%. How in the world does that make sense? So there are some things out there that people are just behind because, they heard Nancy Pelosi bought it, or they heard, Jamie Dimon say it was a good stock, or, and he's a financial guy, or they heard Jim Cramer, heaven forbid, don't listen to that guy. No, be careful. I'll probably get sued for slander, but that guy's a showman. He is not a market guru. Anyway, but I mean, there's all kinds of people that are voices in people's heads, and, people just are way too trusting, especially because it hasn't bit them in the butt yet. Everybody's just jumping on the bandwagon. You get this stock I'm talking about jumps, after earnings, it jumps 20% in pre-market and just, jumps right out of the gate. Well, it wasn't buyers that came and did it. It was the market makers going, oh my gosh, we can probably sucker a whole bunch of dumb money people into buying this stock at a higher and higher price. So there's a lot of institutions that are manipulating the stock market. They're, putting these stocks out at these outrageous prices, just basically changing the bid or offer price. And people get so excited about it. The layperson, or what we call the dumb money, I'm not saying anybody who invests is dumb. They probably have good jobs. They're probably really smart people. But when it comes time to know what's really going behind the scenes of the stock market, it isn't necessarily. Actually, I just looked up that price earnings. The price earning of that stock's over 500 per share. And the earnings per share per year is scheduled to be about 20 cents. And this stock is over 120 bucks or $100. And this is one of the high flyers. So I'm picking one out. You can pick a lot of them out. The Magnificent Seven are almost as bad, being overvalued from the standpoint of how fast they can grow. You got companies growing at 6%, but their stock's been growing at 100% a year, and the PE ratio is 29 or 30. I'm like, well, that still doesn't compute to me. It seems to me that, price earnings should be, the growth should be at least half of the PE ratio because it takes a while to catch up to the actual price you're willing to pay. So can the stock market be irrational for more than just a year or two? I guess it could, but can it be more? It could probably be irrational longer than you could be liquid given a market correction or a market crash where half your money's gone, or like Norm, 80% of your money goes bye-bye and you don't know how to make ends meet other than get part-time jobs and back to work and have to take Social Security early instead of max it out by taking it later, and other things that Norm and other people like him have had to do when they retired and left all their money at risk. So again, it depends on the station of life you're in, whether or not we should be cautious or we could just throw caution to the wind. If you got 20 years between now and retirement, you haven't, saved big chunks of money, like millions, then maybe you ought to just keep dollar cost averaging in, meaning just keep putting money in the stock market. Doesn't matter where it's at, high, low, or indifferent. You're buying, the best long-term stocks. You're buying indexes. You're buying things that typically, are a little safer than just individual stocks, but also, have a tendency to go up over time. Indexes are actually manipulated in a way because if a stock doesn't do very well, they can kick it out of the index. And if a stock does well, they can bring it into the index. So the index could be 30 stocks like the Dow. It could be 500 stocks like the S&P 500. It could be 2,000 stocks like the Russell, which includes a lot more small cap stocks and gives us a better picture of how the market really is doing, the overall market's doing. That's a diversified portfolio. However, they are weighted, they're cap weighted. So capitalization of the company, how much that company's worth, makes every dollar of that stock that goes up, makes the index go up more than, say, another stock that goes up $1. So it's not a true representation. It is kind of a manipulated game. You're not going to be a stock picker, have somebody, an advisor manage money or look at fundamentals and pick stocks or mutual funds or ETFs for you. Indexes are a great way to go. But again, that's if you're a ways out from retirement. Or if you have money, let's say you have a couple $1 million, but all you need is $1 million to make sure your retirement is intact and you have more than enough income to live on. Well, I don't care. Risk the rest of it. We have some great growth portfolios out there. We have great managers that we have access to. Find mutual funds that you like, that have good track records and good management. You can do some research on them and find them. Bottom line is you got to know your risk tolerance. And too many people right now are exposing themselves to far too much risk. And because it hasn't bid them or cost them money, they feel complacent or they feel okay. And I'm scared that there's going to be a day of reckoning when they wish they hadn't and wish they'd been a little bit more cautious. Maybe wish they'd listen to this show more often and taken our advice to not risk money you can't afford to lose. And on the flip side, there's people that haven't made as much money as some of their friends that have been taking all this risk, but they haven't lost money. Well, I've even had a couple of them complain and say, oh, you should have made me more money. Well, if I had a crystal ball and knew the market wasn't going to crash, it was going to go up 29%, I would have probably had everybody in it. I don't care what risk tolerance they had. But the fact is we don't have crystal balls in this business. We can only go on history. We can only go on the likelihood and the odds based on all the different parameters that you look at in the market. The odds are based on what's happening in the market today is what's happening today in 6 or 7 different areas is exactly what happened right before the last big crashes. So why would we expose yourself to that kind of risk? Now, at the same time, when the market crashes, it's a great time to buy. But you know what? It's too bad because that's when everybody's scared and they don't want to buy. So you want to kind of do the opposite. When everybody's complacent and wants to buy, that's probably the time that you need to be most cautious ever. Now, I'm not saying we shouldn't have a little bit of optimism because we have a new president that seems to take a lot of leadership and ownership of the economy. He's using tariffs, like I said, as a bargaining chip, not as an economic spear to hurt us and take our economy down. But the fact is regardless of what he does and his expertise on the economy and business, there are certain cycles that are much bigger than Trump, much bigger than a country, or much bigger than Wall Street. You can only be manipulated so long, I think. Now, every time they've thought this could be different, this time it's different, it's to take longer. Oh, well, we missed the recession. Well, just because it took longer to have the recession, because most of them happen within a 2-year period, and just because we're 30 months into the period where recessions typically are imminent, when inflation goes crazy, when the yield curves invert, when private ownerships become heavier than institutional ownership. And I'm saying these things, if you've heard the earlier programs and other weeks, you know what I'm talking about. I don't have time right now to go into all that, but there's so many things. Savings is way down. Job openings are decreasing and employment is actually going up significantly. Manufacturing is down. All these different things end in recession. So we're at that point where all these things are happening and they end in recession. And could it not happen? You know what? I hope it doesn't happen. But there's a lot of hurt that happens when those things happen. Fact is, the cycles repeat and we need to be careful and we need to be, how do we be right, whether I'm right or wrong, right? How's your investments right, whether I'm right or wrong? Are you in enough principal protected accounts that if the market crashes, you're safe? Do those principal protected accounts go up if market activities and economics are good so that you still make a better than average rate of return than a CD or a short-term bond would make? Do you have some liquid money that is in short-term bonds or money market that you're making 4 or 5% on that you can grab at any time? And if you do need it, at least you lock in a profit, not a loss. Slow and steady wins the race. The tortoise and the hare race is a good example. We're okay being the tortoise. Sometimes, the life of the hare or the rabbit looks a little bit more exciting and pizzazzy. And, right now that's probably where people have to really make that decision. Can I really stomach the risk, or do I really need to, bunker down and say, you know what, count my many blessings because I've saved a lot and the last 10 years have been really, really good to me, especially the last couple have been really, really good. When's it time to take some of those profits off the table, set them aside, and make sure they're there for you for the duration of your life and provide that income that you need when you don't have a paycheck?
We're talking about investment opportunities and threats here in 2025 with Jeff Hogan on Premier Retirement Planning and Wealth Management. Our telephone number, 520-780-9059, 520-780-9059 if you'd like to talk to Jeff about your individual situation and these inflection points here in 2025. They could come in 2 ways, really: President Trump's policies and the Federal Reserve. Speaking of the Federal Reserve, we talked about rate cuts a lot in this program, Jeff. Do you believe that we're going to have any more rate cuts or possibly maybe even rate hikes here in the near future?
We're already getting a rate hike based on the fact that the Fed's selling bonds, meaning that they're taking the money out of the economy. And when you sell bonds, you basically drive the price down. If the price of a bond goes down, the equivalent interest goes up. So the 10-year yield has gone up. It actually hit 5. It came back off that just a little bit. The 20-year bond actually is up. I think it's 4.8 right now. And, might be easing up a little bit. I know Trump really wants to lower interest rates because it will help the economy. We have to watch out about how that might affect inflation. And really, lower interest rates don't actually create inflation if there is adequate supply. And what has to happen in order to make this rate cut feasible and actually a benefit, you could lower rates and have people able to buy a house with a 4% mortgage. But if the house goes up $200,000 before they buy it because of inflation, that's not a good thing, or because of the limited supply. So if we can get manufacturing back intact here in the U.S. and have all the sectors in the economy pumping and moving and shaking, and we have foreign countries that don't want to pay tariffs on their goods, actually build factories here and build stuff here, our economy gets better, we have better supply, we have quicker access to that supply. And if we have supply, tax cuts, interest rate cuts, all those things that create more money flow don't have to increase inflation. The only reason it increased inflation is because, they shut down America and they shut down the world with COVID. They got a supply chain back up and nobody was ever able to recover. The last administration slapped so many restrictions and regulations on companies, they didn't even want to get into business. Then they threatened raising taxes. Nobody wanted to do business. Nobody wanted to create that supply. I think that those days are over. I mean, there's a lot of people that want to get back into business, want to get back into manufacturing. Foreign companies or companies that are based here but doing a lot of their operations in foreign countries because labor is cheaper. Shoot, if they've got to bring that stuff back here and pay a tariff on it, they're going to just bring that business home. So I see this whole situation shaking out over time. I don't think it can be a quick fix in a month or two. In fact, if we look back at the history of Ronald Reagan, he came in and, he came off of a period of stagflation, just like we come off of the Biden administration, where inflation's out of control. People aren't very happy. People are having to work 2 jobs. Not a gas shortage like there was back in the Carter era, but there is certainly high-priced gas. We can get all we want. We just need to. They've used up all the strategic reserves, and they've made gas prices so high that everything else costs more too. So if we can get all that under control, we may still have to go through a little recession before it happens. But I think the outlook is really good, and I think that we'll be able to create the economic structure to where rate cuts are not going to cause inflation like everybody's fearing. I think the rate cuts will be a good thing, but I think they have to be done, carefully. And we've essentially have been having rate hikes, even though the Fed says they lowered interest rates for the last 3 different times to a total of 100 basis points. Had 3 interest rate cuts last year, but they were only on the short-term interest rate. All that did was help them pay short-term interest on some of their debt and, kind of refinance stuff with banks and kind of do their little insider backdoor games with the banking system, because banks and the Fed are basically one and the same. They're partners. They manipulate together. And they're really not a government agency. All they're there for is to make the banks look strong so that we don't freak out and go have a bank run and, cause 1929 again. So they're playing some, fun games. They don't even have to write off their debt and call it losses. They can just basically hand those loans over to the Fed. The Fed can hold them for them and say, well, they're unrealized losses. We don't have to realize them. We're not going to count them on the books because someday we'll have to give them back to you and you'll have to finally count them, but not yet. We're going to continue to pretend that you're making money, not losing money on all these, bad real estate loans and things that happened during COVID that, banks are taking a bath on, but the taxpayers basically are funding that with tax money and the Fed playing their game. So if the interest rates do go down and the Fed stops playing games, I don't know if they're going to have those books reconciled with all that, bad commercial debt that's supposed to be bought back and, some of these things that are kind of left out there in the wings. I don't know if that's going to get fixed, during Trump's term. I think, a good business planning would say, yeah, that should take place. But, again, we don't want to rock the world by causing a banking crisis either. So, it remains to be seen. But I think the goal is to have interest rates lowered so that people can buy things. And as long as there's not inflation, it's a good thing. But honestly, I'd rather have housing prices stay where they are and have interest rates go up than have housing double and have interest rates go down a little bit, because it turns out to be just as prohibitive to buy if they both don't go down together. In other words, lower interest rates keeping things the same, or even have some sort of a recession that would reset the pricing of houses and some of these overpriced goods that people are, especially rich people are willing to pay for because they can. But middle class and poor people can't even get close to it. It'd be really nice to have them participate in the economy again. And I don't think they have for, a decade or so.
We're talking with Jeff Ogden of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about investment opportunities and risks here in 2025. If you've got questions of Jeff, once again, our telephone number, 520-780-9059. That's also the number that you can use if you'd like to get in and sit down and talk with Jeff on a one-on-one basis, talk about your individual situation and maybe what your next move should be for 2025, the things you should watch out for. Again, 520-780-9059. Make that call this weekend. Leave your name, telephone number, and Shelley will call you back during the week and set up a time for you to come in and sit down with Jeff. Again, this is just a casual conversation. You don't need to bring your tax forms, anything like that. And again, there is no cost, absolutely no obligation. It's a chance for us to get to know you. You get to know us and determine whether or not we're a good fit. 520-780-9059. You can also find out more about us online at premret.com, PREMRET.com. Jeff, in looking at our portfolio and preparing for 2025, what are some of the things that we should concentrate on, some of the things that we should be looking at?
Well, I think a big one is rebalancing a portfolio. There's people that have had, NVIDIA, let's just say, for 10 years in their portfolio, and now it makes up 80% position, but they don't want to get out because, it's still making money. Well, it probably is, but it still doesn't hurt if NVIDIA ends up, finding out that there's another competitor in town besides this DeepSeek that came out and, dropped NVIDIA 20%. I mean, what if you have $1 million and 800,000 of it is in NVIDIA, and in one day you lose $160,000 on one position? And what if that situation is real, where NVIDIA's maybe peaked and, their growth isn't going to be as strong because now, you've got AMD and, Micron and all these other big companies, TSM, Taiwan Semiconductor, and some of these other companies that are creating fast chips, and some Chinese companies that are getting into the market. So, what happens if all of a sudden they become less than, ideal as far as their growth or their status in the marketplace? So, you don't want to be overly invested. There's another one I just talked about earlier that, went up 400% in the last few years. Rebalance those, maybe take half of that off the table and redeploy those into new up and comers that, are following behind it. There's a couple of other competing companies with that company that are kind of in the same space. One of which I know has a price earnings ratio of about 30, and it's doubled in price in the last year. This other one's got up 4 times in the last year, but it's got a price earnings of almost over 500. I mean, I'd rather take the one that has a little bit more of a fundamental and is actually growing earnings at 3 or 4 times the clip than the one that's overpriced. So, rethink your exposure to things that have gone up that might be kind of exhausted as far as their run goes. I would also caution people to remember that stocks and bonds are not necessarily, hedges with each other. Stocks can go down, bonds can go down. Most people that are in bond portfolios are still down, and they wonder why their portfolio has not been growing, is because as interest rates have had to go up to fight inflation, and even though the Fed says they lowered interest rates, bonds have continued to drop in price. 20-year bonds down over 20%, the 25-year bonds over 30. The aggregate bond portfolio is still down over 10 or 15 from when it peaked a few years ago. So if you're still holding on to bonds, either write them out or just, consider, is there going to continue to be increases in interest? If so, your bonds are probably going to lose money. If, however, you got out of bonds because they lost money, and you think, and I'm leaning this way too, and I'm still waiting to see it play out, but, if Trump gets the supply chain kind of figured out, the economics rolling, and he, puts enough pressure on interest rates, or if we go into a recession where people do, fly to what they consider as more of a safe play in bonds, the price of bonds will actually go up, which means interest rates will go down. Or if interest rates go down, it typically does reflect in an upswing in bonds. So we might want to consider reallocating into the bond market this year as we see those interest rates stabilize and even start coming down. So that's another thing to consider, especially if you got scared out of bonds from earlier. If you're still kind of just riding them out, well, just don't be upset because your portfolio is still down. That part of it may come back if interest rates go down. But again, if inflation continues to be a problem and bonds continue to fall because inflation is a problem, interest rates typically are kind of forced to go up. And if that's the case, your bonds are not going to be that safe haven you thought. Consider some alternatives. I think gold and silver has always been used as a hedge. I think not so much as a hedge, but I think it's a viable asset class now just to include in a growth portfolio. I think the trajectory of gold and silver and precious metals is something that a lot of people think, well, I only have a few coins in my safe in case the world comes to an end and I need to trade it for bread and food with my neighbors or whatever. I don't think that's necessarily a bad idea to have a little bit of gold and silver if that's, your thing and you want to be prepared for whatever could happen. But you can buy gold and be exposed to gold through ETF, exchange traded funds. I am not a proponent of buying it through those IRA things where they have actual physical gold where you have to pay a big commission going in, big commission going out. Those are gold and silver brokers and they rip you off. So you can play gold and silver through Wall Street, through ETFs, exchange traded funds with virtually no cost, get in and out of them at any time. It's liquid. So there's some things, consider your bond holdings, consider rebalancing, especially those positions you have large exposure to. Don't get out of them. Just dial back, take your profits off the table so that if something does happen, you always locked in a big gain. You can never get hurt taking a profit. And that's one of the old adages that I learned when I was a stockbroker is the only people that didn't get hurt, in the 87 crash was those people that took some profits before that happened. The only people that didn't get, hurt in the 2000 crash is those that kept taking the profits off the table during that late 90s run when the dot-coms are going crazy. Same thing with the '08 crash. Same thing with any of the corrections of late. If you keep taking profits off the table and park it in a safe place, that's money you don't have to worry about losing. That's money you can rely on down the road when you need income or when you have an emergency come up where you need the cash.
If our conversation has piqued your interest today, call us, request your Premier Retirement Roadmap, 520-780-9059. No cost, no obligation, 520-780-9059. Jeff, time for a break. When we come back on Premier Retirement, we're going to answer listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
Thank you so much for joining us and making us part of your weekend here. You're listening to Premier Retirement with Jeff Hogan. My name is Jeff Shade. We're here for you every week for your fiscal fitness, your financial education, and to answer your questions. We're on Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. here on 790 KNST, Tucson's most stimulating talk. And as always, we are a podcast. If you've missed any part of our program today, go to wherever you get your podcast. You can Google it if you want, Premier Retirement with Jeff Hogan. You'll find this show and many, many of our past shows to keep you busy and also on track for a confident retirement. Okay, Jeff, time for listener questions. We'll kick it off with Ron listening to us in Tucson. And Ron writes, the direction the U.S. economy is headed is frightening for someone with only 14 years before retirement, especially with my job being grant funded. I've been in the nonprofit world my entire career, so my 403B is less than $500,000. I'm in my 50s and concerned about interest rates, tariffs, inflation, and the general performance of the economy and markets. Do you have any suggestions as to how to shield my retirement savings from the unknown?
I mean, obviously, you've got 500,000. That's a nice chunk, and it'll be terrible to lose it or terrible to have the market crash 50% like it did in '08 and that and then some in the 2000 crash and take 7 or 8 years to get back to even, which it typically does. Now, keep in mind that you'll be putting new money into that 403B, assuming you keep your job for the next 14 years. And as soon as they're matching your 403B at your work, I don't know if they are or they're not, but always take the free money if you can get a match. But let's just say your assets grow by, let's say they average 7% over the, even with the ups and downs, and 14 years is probably enough time to get through a cycle. However, I'm going to give you a different suggestion after I explain what I'm going to explain to you. Even though you're in your 50s and you're 14 years from retirement, now I don't know if your 403B, because you work for the nonprofit, you may not be able to touch or do anything with it between now and the time you actually retire. If, however, your 403B is from a different charity or a different, school, hospital, or whatever 403B situation, wherever you got that from, it sounds like it's nonprofits from charities. So if that's the case, you may or may not be able to access it. If you can take that $500,000 off the table and create a situation where maybe you have a guarantee of somewhere in the neighborhood of $100,000 a year guaranteed income 15 years from now. With that $500,000, if it's portable, you could buy an annuity with an income rider that gives you a bonus and guaranteed, growth. Actually, it would be probably not quite 100, maybe $80,000 or $90,000, but that's pretty strong. I mean, you're looking at 15 to 20% withdrawal rate on your present dollars in 14 or 15 years from now. The rest of the money, I don't think you should be concerned with where the economy is. Well, you should be. I mean, obviously, we don't like a lot of things about the economy, but in the next 14 or 15 years, we don't even know how many changes can be made. We know what Trump says his direction is and what we're going to probably see in the next 4, but all the next party's going to do is say, oh, he took it too far. Oh, he didn't go enough. We can get it farther. And of course, they'll, do their dog and pony show and dance. And who knows, maybe America's ready for a change because, Trump just wears us out with his energy and we want to kick back and do something different. If that happens, then who knows what the economy is going to be like 4 years from now. I mean, 14 years, you've got 4 elections between now and then. So, I'm sort of frightened about, what could happen, but you have to just take every chunk of time by itself and, make decisions that only you can control. And one of the things you can control, if you have access to that $500,000, is to stick it in a place where you can't lose money. And it will continue to grow at a guaranteed rate or at least a market-related rate while the market's good. And if the market's bad, you still lock in the gains along the way, but it never goes backwards. I mean, that's a significant benefit to retirement planning that come around since I've been in this business. And thankfully for more than half of my business, we've had access to these type of products that don't go backwards, that only go forward. They may not make as much money as a 20-year back-to-back performance in a stock market, but it also won't have a down 50% and a down 48% or whatever the markets could do in the next big correction. So, consider that. But also, I would consider dollar cost averaging, or if there is a safe place, if you can't do something outside of the 403B, if there's a low risk or a more conservative way to invest your 403B for now, because the market is really overvalued, put all your new contributions. If you're putting in $500 a month, let's say, or maybe it's $2,000 a month into your 403B, whatever it is, just dollar cost average that into the stock market into something that's aggressive. I mean, if you're only putting a couple thousand a month over the next few years, you're only going to have 20, 30, maybe $40,000 in there. And if the market goes down half, well, you keep buying it and you're getting all your purchases on sale. So you're actually buying cheaper, and in the long run, you'll end up making more money. You don't have to worry about market corrections when it's the small chunks of money that you're putting in on a systematic basis to your account. It's losing 50% of the big chunks, like 500,000. That I would consider as a significant or a pretty big chunk for retirement that you could do a lot of good with as far as securing income or securing some sort of a retirement income. So again, there's a couple of different ways you can play that game. The other thing is depending on your income, if it's higher than what your 403 allows you to max, you could fund some things outside of a 403B or a 401k or an IRA or a qualified fund. Fund it in what we like is the rich man's Roth or a LIRP, basically use life insurance to protect assets. It not only protects it from creditors and predators, it also protects it from the tax man. So you can actually park money there, grows tax-free. You can actually get it out tax-free, not just by dying. You can actually borrow against the death benefit or borrow against the cash value while you're living and basically use tax-free income in retirement. So you might want to look at a more comprehensive plan. Again, depending on any excess income that you might want to reposition other places during this last 10 or 15 years that's in a principal protected and steady growth type mode. And you might want to also look at ways that you might be able to take that $500,000 and de-risk it, at least to some degree.
That's a good question, Ron. Thank you for listening to us in Tucson. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Our telephone number, 520-780-9059. If you'd like to get in on the conversation, leave your name, telephone number, and Shelley will call you back during the week so you can sit down and have a conversation with Jeff. Our next question, Jeff, is Les in Oro Valley, short and sweet. Les says, what is a hedge fund and should I invest in one?
Man, there are more ways to define a hedge fund than there is flavors of ice cream, seriously. And I know there's at least 31 from just one store. There's more than that. There's a lot of things. The hedge funds aren't necessarily a hedge, meaning hedge funds aren't necessarily a fund that if the market goes down, I'm definitely going to keep my money. Those are very few and far between. What a hedge fund is really a person that manages money that doesn't have to keep the same rules as a ETF, exchange traded fund, or a mutual fund. Mutual funds, for example, if they have a growth fund, they have to have 80%, because they call it a growth fund. Just the Truth in Advertising Act says you have to have growth stocks in that fund, or 80% of that has to always focus on growth. And the most you could ever have in cash is 20. Well, a hedge fund says, we don't want to live by those rules. If we think the market's crashing, we want to go all in cash. So that would be, one way that they could hedge. Or we want to buy gold and silver because that historically has always been a hedge. Well, I don't know, gold and silver, if you look at the last 40 or 50 years, maybe has averaged 2% a year. I wouldn't say that's a good long-term investment. It might be a hedge when you see that central banks all over the world are buying gold, and you see that it's being used more and more, gold and silver, and precious metals are being used more and more in electronics and different things like that. There's actually a value to gold that's not just for rings and necklaces and jewelry. It's actually got, more value than collector value, whatever. That might be, I would consider that an alternative investment, or basically just an asset classification that you might want to invest in. I believe a hedge fund, if it were named properly, and I think a hedge fund is a good thing to have, but a hedge is something that should have some sort of protection when everything else is falling apart. And that's why we use fixed index annuities, which means fixed meaning safe, and the index means they go up when the indexes do well, but they don't go down when the market goes down, and they lock in profits along the way, either every year, every 2 years, every 3 years. We have some that ladder the lock-in period where some of your money locks in every 1 year at a certain amount, and on 2 years, they give you a bigger percentage of the gains, and 3 and 4 or 5 years, a bigger and bigger percentage, the longer you're willing to hold it. those back test really good. They're kind of new products on the market. But if you look at how indexes and how, market cycles go, you could do really well, not risking a dime of your money and let an insurance company insure it without having to pay a hedge fund manager 2 or 3 or 4% to manage your money and take a chance on losing it just as fast as you could lose it somewhere else. There are some private equity funds that use real estate. Those would be considered in some ways a hedge fund. But then again, you're subject to the real estate market. What happens, if real estate crashes? Will it? I don't know. Maybe it won't. But if you can't make money on the growth of real estate because interest rates, the carrying costs and the building costs and everything is getting so out of whack, maybe that's not a great money earner either. I would look at insurance companies probably being the best hedge fund managers, even though it's probably a misuse of the word. If you talk to a Wall Street guy, they'd be cringing if I ever equated hedge fund with insurance. But it's a hedge. It's where they insure your account from loss and give you upside in the market. So why isn't that a hedge fund? Oh, I had a hedge fund, a friend of mine managed a hedge fund where their fee was 20% of the gains. But when that hedge fund, it was actually a real estate hedge fund that blew up in 2008. And guess what? They don't give any of your money back. They don't share in the losses. They liquidate and go, well, there was no gains. Your money's gone. Well, hope you enjoyed the gains along the way because it's over. In fact, one of the guys that was partnered up with this friend that I'm talking about actually ended up committing suicide because of the losses, and he couldn't live with himself after that. So there are some really crazy, and I don't know if I should go down that road, but there are some really crazy hedge funds that are so risky, you don't even want to even be around. So don't use that word hedge lightly. I mean, look for a hedge fund that actually does what you want. Don't look for a hedge fund just because rich people use it and you think it's really cool and you want to throw some money at it because you could make a killing. Most of those hedge fund managers are buying yachts and, skyscrapers and condos in Vail on their profits. And they're really not as concerned about your money, I think, than they are sometimes the fees that they generate, manipulate the market and whatever they're dealing in. So be careful on how you approach hedge funds. Some are really legitimate and some are, really kind of in my opinion, a scam.
Les, thanks for listening to us in Oro Valley. And of course, you'll get Jeff's book, Retirement: The Road Ahead. Our phone number, 520-780-9059, if you'd like to get in on the conversation. Next question, Gary, listening to us in Green Valley. Gary says, I'm 64 and getting married for the second time. My wife-to-be has 3 children, all grown. I have 3 of my own, all grown. I want to set up some kind of an arrangement that will provide for my wife if I should die first, but will make sure that the assets that I've accumulated over my lifetime go to my children, even if my wife wants them or a portion of them to go to her children. What do you suggest?
Well, there's a couple of different ways to do it. Beneficiaries listed on assets trump all. However, if you're getting married and you're going to be in a community property state, I assume you're going to get married and stay here in Green Valley.
Right.
You basically, the marriage kind of combines your assets unless you purposefully and specifically designate them as sole and separate property. You could do that with some of the assets and just designate beneficiaries. You don't even need a trust for that. For example, my mom has a few assets and now she doesn't have any significant assets. And, she was married a second time after my dad passed away, but there was really no issues on that. But she has like an IRA, an annuity, and a life insurance policy and a house. Well, my brother helped her fix the house and is actually living there with her. He gets the house and each one of the other assets has a beneficiary name on it and it's one of the kids. So we all are going to get that direct. Now, if my mom marries a second time or a third time and some guy wants that money, he doesn't get it because it's kept sole and separate property. It's never commingled. If, however, you get married and then you decide to set these things up in a trust or change the beneficiaries, if you're married, your wife would have to disclaim access to that particular asset or account. Now, I know you want to provide for her. Now, you could do a trust where everything goes into the trust, but you make your wife only eligible to get maybe gains, but no principal out of the trust. And you leave maybe one of your children and maybe one of her children as trustees, co-trustees, and they would have to agree. Or you just leave one of your children. If you're the bulk of the assets, maybe you use, one of your more responsible children and say, hey, look, I want to make sure that you take care of, my, your stepmom, but in the end, I want it all to go to you guys. Meantime, you need to pay for her bills, blah, blah, blah. So, if you trust that person that you put on as your successor trustee to take care of your wife, and I'm sure they'll have no problem withholding it from the other kids unless, they got some sort of side arrangement behind your back, but that probably won't happen. So you could use a trust, but remember, a trust is only as good as the word trust. You have to trust somebody. You're not getting over It's not being overseen by lawyers and, fought about in court. That's a very costly and time-consuming process. I don't recommend probate for anybody, but, in some cases, if there's a lot of fighting and bickering on, sometimes that's the only way you can solve that problem. So hopefully you can solve that without it ever resulting in a probate issue, either through a trust or just through setting aside certain assets for your new wife and certain assets that are set aside for your present children and just are never considered part of joint property. And if that's the case, then you can leave them separately to those children.
Gary, thanks for listening to us in Green Valley. We appreciate that question. We'll send you out Jeff's book, Retirement, The Road Ahead. If you have a question you'd like us to answer on the air, you can get it to us by calling it in to Shelley if you want. 520-780-9059. You can also go to the website, which is premret.com. Use the contact page there. If we use it on the air, you'll not only get a snappy answer, but you'll also get Jeff's book, Retirement, The Road Ahead. You're listening to Premier Retirement with Jeff Hogan. And again, if you'd like to get in and sit down and talk with Jeff about your individual situation, request your Premier Retirement Roadmap. No cost, no obligation for that. 520-780-9059. Make that call right now. Leave your name, telephone number, and Shelley will call you back during the week to set that up for you. Just a casual conversation to ask the questions that you need the answers to put you on a path towards a confident retirement. Once again, it's 520-780-9059. Jeff, let's move on to our next topic on the program today, and that's how to plan for the future when it is unknown in retirement. When I think about the unknowns in retirement, I think about financial stability, market volatility, inflation. There's unexpected expenses, healthcare concerns, longevity risk, lifestyle changes, and of course, not the least of which would be legislative and economic changes. With all of these unknowns, Jeff, how do you put together a plan for someone?
The comprehensive plan really is all about generating replacement income for the income you used to get from a job, right? It's like, how am I going to pay my bills? What's going to be coming in? Maybe there's some left over. How can I, make that last for my kids? And remember, the 5 pillars of planning are your investments, strategies for investments and protection strategies to protect the wealth that you've created. Make some if there's opportunities to make some, but also risk only the amount that you can afford to lose weight on or not need for everyday income. The next is the income plan. Now, along with income is a tax problem for many. Many responsible savers have really large 401ks and IRAs and qualified plans that have never been taxed. And when you pull that money out later in life, guess what? You get taxed on that money. If there are larger assets, or if you want to maybe increase your income in retirement because you're actually going to do fun stuff that costs a lot more money than you did when you were working, because all you did is go back and forth to work and didn't do a lot, you might find out that your income needs actually increase during retirement, which means your income tax bill might also become bigger. So we have to look at that. Where's your money coming from? How can we moderate the taxes or mitigate the tax problems that might occur, especially when you turn 70 something and 73 right now, but it's going to be 75 for some future retirees, and make sure that those required minimum distributions don't hit you between the eyes. So we look at the investments. We make sure that there's certain investments that can either guarantee or predict some sort of an income source. We could do that through, could be dividends and interest through stocks and bonds. It could be annuities that either are guaranteed for a fixed period or even for life. I don't like annuitized annuities, by the way. But there are annuities that give you guaranteed income and still let you have access to the balance of the account, which I do like. Some people like to play some strategies with their stocks, do covered calls and things like that, where they actually own the stock, but they'll say, hey, for $2, I'll sell you my stock at $5 more than what it costs right now. And so if the price goes up, you made $2 plus you were guaranteed a $5 profit on the stock that you just optioned out. If your stock kind of maintains its own price and doesn't go up, well, you made $2, but somebody else paying for the option to buy it from you. So you might be able to enhance returns that way. That's kind of more of a sophisticated play. You can have private equity. REITs are a popular thing. I don't like REITs by and large, at least not the ones that are not already publicly traded. There's too many conversion fees and other aspects to getting a REIT started, where the initial purchases of REITs usually are the losers, not the winners. Let's see, what other ways to generate income? Obviously, if you're into real estate and want a job during retirement, you can be a landlord. I'm not really that good at that type of a business. I've tried it a few times. I hate it. I would not recommend it. But you can also be a lender for real estate. There's some investors that can't get loans at banks, but they would love to pay you more than market rate on interest. If you can make 8% and secure it with real estate, on a loan, that because they can't get one at the bank, that might be better than what you're making on a CD, especially if, just interest payments are okay. And if you're willing to foreclose on that house if they default. I wouldn't go into areas like Bitcoin and some of these crazy things that are just pie in the sky, hope I make money type things. But those are the main areas that we would look at to generate income and basically be the central area of the plan. So in other words, we have to make sure that those investments make sense and are generating either predictable income or guaranteed income. And now we look at the other thing, and that I haven't mentioned yet, that is a tax-free version of an annuity, which is predictable, not guaranteed income, but it's where you stuff a life insurance policy full of all the cash you can. You basically hide it from the IRS and everybody else, because life insurance is one of those stealth things that don't issue 1099s. They don't have a taxable event unless you treat them wrong. But if you do it right, you can overfund an insurance policy by, let's say, $1 million worth of death benefit, and you can stuff maybe $500,000 or $600,000 into one of these. That money grows, but you get to borrow against that future growth. And pretty soon that $600,000 that you put into it grows to $1.2 million. Well, guess what? Your death benefit isn't $1 million anymore. Now it's $1.5 million. And then it doubles again before you die to maybe $2.5 million. And now you have $3 million in potential death benefit. I'm kind of exaggerating or rounding. It might not be exaggerated depending on your age and your health. But so let's say you put $600,000 in there, but you might get, a couple $1 million out in actual withdrawals because you're borrowing against that future death benefit. When you die, you get the balance of it minus the interest that those withdrawals would have, the money that basically the insurance company would have made on that money, they're going to give you. They're going to just basically deduct the interest when you die. So it's totally stealth, but that's a tax-free way to not get hit with future tax burdens on IRAs. If you're willing to pay a little bit of taxes now, you can look at a tax strategy like that. Or you could also look at charitable gifting if you have a big enough estate that makes sense. Or if you just like charities, you can do donor advised funds. You can do direct charitable contributions from your IRAs instead of taking the required minimum distribution into your own account, calling it income, and then deducting it when you give it to the charity. You could actually give it straight to the charity, and then it never counts as income. So that might help keep your tax on your Social Security lower. It may help keep your IRMA, the extra money you pay on Medicare premiums, down, and a lot of other things. So there's just such a myriad of things that you're probably not going to think about before you retire, but you're going to learn about the hard way when you retire, about taxes and all the excess charges that you're going to get just for being retired, like tax on your Social Security, potentially a lot more than you think, potentially higher Medicare premiums than you thought you would owe. The tax situation may not be as rosy as you think, because most people think that as soon as I'm retired, I won't be in this high tax bracket because I won't be working anymore. That may or may not be true. For more than half of our clients, it's exactly the opposite. So take that into consideration. And then there's always those healthcare options that you have to worry about. And then the final one is legacy planning. How do you give your stuff to who you want, how you want, with the least amount of trouble, least amount of taxes, and by avoiding probate?
We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management about planning for the unknown here in 2025. Again, if our conversation has piqued your interest in any way, shape, or form, give us a call here at Premier Retirement to request your Premier Retirement Roadmap. Our telephone number, 520-780-9059. You can also go out to the website at premret.com and find out more about us, PREMRET.com. Well, Jeff, we just get started and we run out of time. Once again, 520-780-9059 is our telephone number. We appreciate you listening to us this week. We invite you to join us again next week right here with another edition of Premier Retirement. Go Chiefs, go Philadelphia Eagles. Enjoy your Super Bowl. We'll talk again next week right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.
Hi, this is Jeff Vogan, founder and CEO of Premier Retirement Planning and Wealth Management. We're in the financial planning business so you can be in the let's have fun and not worry about your retirement business. It makes no difference to us whether you want to hang out with the grandkids, go back to school, start a new career or hobby, or spend your retirement partying in the Caribbean. These are your choices. Our mission is to help you protect your life's work and turn it into a predictable income plan to finance the things that make you happy. Premier's investment philosophy is simple. Protect and manage your savings. Create strategies that seek not only to provide an income stream you can count on, but to grow your principal to keep up with your lifestyle. Retirement the way you want it. Finding the right partner that really understands you and your goals could truly shape your life for the next 30 years or more. So call us at Premier Retirement Planning and Wealth Management for a complimentary, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or visit us online at premret.com. That's PREMRET.com.
Investment advisory services offered through Premier Wealth Advisors, LLC, and Arizona State Registered Investment Advisor.